2018.
Hello and welcome to a fresh new edition of Taking Stock. This is the show where we look back at the week which has gone by and look ahead and try and prepare you for what lies ahead. The week has been good. I mean, actually, to be fair, the last three trading sessions have been absolutely spectacular, as we will show you with numbers and percentage points. But I think we're also getting into the fag end of this year, and that gets us into thinned out liquidity conditions and so on and so forth. In terms of news flow as well, the week gone by was stupendous. I don't think in terms of news flow, we're going to get anything close to what we got over the last, 72 odd hours or so. With me is my colleague, Sumaira. Hi, Sumaira.
Hi, Prashant. And you're right. I mean, what a week. We don't get these weeks like, through the year. And we've seen a regime change, not just in a few states and key ones at that, but also at the Reserve Bank. Absolutely. And the market has been undisturbed.
So it's been puzzling as well, right?
Yeah.
I mean, absolutely puzzling. You know, so actually, we're going to bring in our guests. Ratnesh Kumar is going to run us through what he makes of the market on a fundamental basis. And we'll get you a technical chart check as well as just a bit. But just to set the tone going in terms of what has happened, over the course of the last week, I mean, actually, in each of the daily market wraps, we've discussed, in a way, how puzzling the market reaction has been. It has been puzzling. I mean, you look at the reaction on your screen at the end of the week, and if you completely missed the news flow, you would have thought, well, the BJP swept all states. And there were some rate cuts from the RBI or something of that sort. But this is the three-day change. Nifty up 4.5%. I mean, from the lows 3 days back, basically. And that was a big day. The Nifty Bank is up almost 5%. The mid-cap index is up 7%. The small-cap index is up 7.5%. From the lows of 3 days back to 3:30 on Friday, these are the changes. So, I mean, we are basically looking at some pretty steep, sharp rises which we're taking in. A lot is, as we look forward, I think there are a couple of things, not too much, but just a couple of things. There are no big scheduled, what you would call risk events in that sense. I mean, risk events would be state election results, for example, or an RBI meeting, for example, or something else of that nature. I mean, things which could really sway things on the bullish or the bearish side. You look ahead for the next 10, 15 days, I mean, something could come out of nowhere, but in terms of scheduled events, there is not very much. So, if bulls out there on the street have been using that and saying that, you got a clean pitch and you got a runway, and maybe you could continue to bat fearlessly and take positions as you go in. I mean, basically play the momentum if there is momentum, and events are not going to really disturb you and cause trouble. So that is one way of looking at things. You come to the other point, which is the fact that expectations are still pretty high. I mean, the RBI board meeting was out there on Friday, but the expectations that the Reserve Bank of India will do something on liquidity conditions, the government may do something as far as fiscal stimulus is concerned, and it doesn't have to happen over the next 10, 15 days. But, markets and sectors and pockets of market can stay buoyant on expectations that, well, they're coming sooner than later. So that is a powerful, hope is a powerful factor, as always. And I think that hope is still very much there. You can look at financials as an example, or NBFCs, etc., which saw pretty good price action. Global markets, as always, as we get into the fag end of the year, see extremely thinned out liquidity conditions. News flow dries up and everything, and people go on leave. And it happens every year, and it's happening this time as well. So price action, especially on big indices like S&P, etc., remains pretty volatile. You see openings sometimes which are 300, 500 points lower. By close, you're sometimes up, you're sometimes flat. And it's happening quite frequently now. So I would say price action from the global market or any sort of untoward announcement remains a risk factor. But apart from that, locally speaking, in a way, you've got a bit of a a clear runway. If there is momentum, I guess people pile on to it looking at that. Sumaira.
All right, Prashant, that's actually sums it up pretty well. So let's take it to our guest, Ratnesh Kumar, the MD and CEO of Bob Caps, now joins in. Ratnesh, hi. What a week it's been, right? And I guess you've been very busy, but a lot of the themes have seemed to have gotten fair play, right? Whether it's the rural theme and the hopes that there could be more populist measures, this whole NBFC, PCA banks, realty play. What's the theme now for next week and as we go in towards the end of the year?
So the theme for next week will be actually, more thinning out of market activity and volumes, simply because you'll have lesser global participation in all emerging markets, including India, and domestically also we see that during this period, there is a slowdown of the actual market participation during the holiday season. So I think that will be the predominant theme. But nonetheless, I think the most important thing will be that rather significant large events which were there on the horizon, like the state election results and change in leadership in RBI that we had, I think those are behind. And once again, the market will be looking forward to what sort of earnings that come out in January, and those and of course the liquidity measures which could come in from the central bank to ease up, although things have eased up already quite a bit, and those sort of things. But I think it will be slightly misleading to conclude what the trends emerge in the next 1 or 2 weeks because of thinner market activity, but it'll be preparing the ground for so to speak, return back to normal in January.
But the bias is bullish, Ratnesh, you would say?
No, I think without looking at the near week sort of performance that we saw in the market, I think the bias for the market is going to remain in sort of uncertain waters for the next 4 to 6 months. There will be periodic up, periodic down, but I think in terms of there will be no clear-cut bullish or bearish signals that the market will be able to get. It'll grapple with one or the other, but I think the clear-cut signals will be missing till such time as we get through the whole election cycle and the run-up to that.
Just to look back at the week, the reaction to state election results, the shock exit at the RBI, and then the market rallies on. Was that the right reaction? There is no right or wrong, I know that. But according to you, is that reflecting reality, or is that reflecting just, a changed narrative and perception, and it sits poorly when you compare it to what the reality may be in the next many weeks and next couple of months, as you said?
No, it certainly reflects reality. I think the market is telling us that it is moving on from state-level elections because there are different schools of thought in terms of how much of the trends in state elections kind of get superimposed or can be extrapolated to the national elections, especially 4, 5, 6 months is a long time in politics. So overall, but what the market is telling us from last week's action is that it is moving on beyond the state elections, and as and when the trends come in for the national election, that is when it'll come back to focus on that. In the interim of that, I think the focus will be on things like inflation, which is within a low range, and as a result of that, can RBI change its posture come January, February? Our economist certainly believes that if the inflation remains in this low range, there is possibility of RBI to change its stance towards more positive side come Jan, Feb. So I think the market's focus has moved on from the state elections to those kind of things, and of course earnings that will come through in January.
Ratnesh, the week has been quite interesting actually for mid-caps and even the junior stocks, if you were to look at it. Is that a play that you see continuing into next week or perhaps even further down?
I think if you look at the entire period from now till the elections are done, that will present a whole lot of different opportunities in large caps, mid caps, and the market is pretty well cognizant of that. So anytime that you have volatility, the worst phase for the mid caps is over in the early part of 2018. In the second and the third quarter of the calendar year 2018, and I think there is a fair amount of constructiveness in terms of picking up good mid caps, and I would expect that to continue. Whatever the trend is, you can't sort of, in the volatile period of 4 or 5 months, you probably can't sort of focus on or predict a particular trend, but I think the market will be very much focused on stock picking and picking those mid caps, for the longer term, investment strategy.
Ratnesh, is there a demand problem developing, in your opinion? You look at passenger car sales numbers, you look at cement utilization, you look at the steel sector at the margin, incrementally what is happening, oil demand, for example, the first half of this year. I mean, it's actually half of what we've seen over the last couple of years, same period. What are your thoughts?
Yeah, at the same time, when you look at the IIP number for, it was pretty good at 8%, thereabouts, and pretty broad-based sort of growth contributing, to that. So I think on a broad basis, you will have GDP numbers this year which will be better than last year, and you will have earnings growth this year will be certainly better than last year, and overall I don't see sort of a major demand problem. Naturally, you've had rates which have gone up in the system, especially from the finance companies, which were feeding into or driving demand in many of the financing-driven sectors, one of which you mentioned autos. So there is bound to be some negative impact of those higher rates that you will see in the second half. And the metals margin that you mentioned, I think that is more driven by global factors. I think in the first half, what you saw in the first 2 quarters of the current financial year, a lot of the earnings growth was driven by global commodity sectors. They will not be able to sustain that driving force, and as a result of which, as you look forward, demand problem is not anything significant. It is where the financing is there, or the cost of financing going higher, where that impacts. You will see that, but on an overall basis, you will see the drivers of earnings growth change for the market from the first 2 quarters to these 2 next quarters.
Ratnesh, in the first week of Jan, we expect AMFI to actually release, the biannual list of large, mid and small caps, post that recent rejig by SEBI in terms of them being reclassified again according to their market cap in the criteria that SEBI has specified. Therefore, mutual funds will have to then recalibrate their funds accordingly. Could this sort of, churn cause any volatility in the early half of Jan, or you think it would be a seamless process?
I think it will be absorbed. The maximum impact that you probably referring to is earlier this year in January, February, when the first time those classifications came into play. That was for the first time it was happening, and it resulted in fair amount of churn and, in fact, a lot of negative impact on the small and the mid caps. I think now the structure in the system is quite well known to the market, and some of the changes which could come can probably be anticipated, and hence you will not see significant impact of that on the market overall. Individually in some of the smaller stocks, you could have stock specific impact, but not for the broad sort of impact that you saw in Jan-Feb earlier this year.
Ratnesh, what are your sort of top ideas at this point? What are you most bullish about?
Yeah, so I think I would be most positive here on a 1 to 2 year basis on corporate banks, because you've had worst of the hits which have been seen already, be it in terms of the NPL cycle and the provisioning trends. So I think incrementally what you are seeing is that the growth is coming back, in terms of credit, and more importantly, on the balance sheet side, the worst hits have been done, and the recent tightening that you saw in the system is likely to improve margins also for a lot of the corporate banks. So I think both on the private sector side or the public sector side, you will find numbers being quite strong recovery in the corporate banks in the next 2 quarters, which is the current quarter and the next quarter. And to my mind, they could actually be one of the major driver of market earnings and profit growth in the second half. So that would be the segment to focus on, to my mind.
All right, Ratnesh, thanks very much for joining in, and we hope you have a happy new year. In case we don't speak with you again, thanks very much. On that note, let's take a very quick break, listen into some market opinion that we've got through the week, and when we come back, we'll touch base with Mitesh Thakkar, who'll join in with some technical trades. Stay tuned.
Earnings recovery has been quite elusive in last actually 2-3 years. I mean, if you see that aggregate earnings of last 4 years, that has not moved up much. Dramatic fall in the oil price from 85 to say 60, if it stabilizes here, would definitely start showing up, maybe not in December, but in March quarter we'll start seeing the earnings recovery coming on the way.
I think this is the time to continue hold on to your retail focused private sector banks. Plus it's time to add corporate focused private sector banks as NPA cycle seems to coming to an end, and some of the recoveries will start getting reflected into the balance sheets. So this is the combination which will work. You want to invest with slightly defensive nature of growth, where despite political situation, growth can continue.
I am positive on the markets for next year. So I go back to 2013, and we had a lot of uncertainties even in 2013 entering the election. And I think the good part is even then the macro was improving. You go back to Rajan's stint at that point of time and how inflation started to improve. We are seeing similar, which is the macro is improving. I really don't know what happens at the elections, but typically when the macro improves, the markets tend to follow. So I would be positive for 19.